On board our corporate voice to chat about the Q4 numbers of music broadcast. Apurva Purohit, the director of the company, joins us now. Apurva, let's start with the key highlights of the fourth quarter and what is the outlook looking like on the revenue front? How do you see the revenues play out going ahead as well?
Okay, so the quarter 4 highlights are as follows. Our EBITDA margins stand at 36%. On an annual basis, that translates into a 33% margin number. At the beginning of the year, we had guided around 31-32% because this was the year of phase 3 investments. And we have done better than expected and delivered annualized 33% and this particular quarter 36% margins. The top line growth has been 14%, and in that sense, we believe we are an outlier as far as media is concerned, because this is possibly amongst the highest growth the media industry, a player in a media industry has shown in this particular quarter. The three key takeaways are as follows. One, there seem to be some macro indicators which are working in the favor of the economy. This economy seems to be showing a certain rebound in this particular quarter. The other two things, of course, are that as far as Radio City is concerned, our strategy of focusing on expanding our reach rather than going deep down into multi-frequency in metros seems to have paid off. Our phase 3 stations have broken even in this particular quarter. We were expecting them to break even in September of next year, and that's really the third reason why we've delivered these margin numbers.
Your margins have also been very healthy in the last few quarters. Could you tell us specifically for this quarter, what were the factors that were driving it?
So clearly from the 33% margin that we delivered this year, which was in a tough year with lesser than expected revenue growth and with our phase 3 investments playing out fully in this year. So from that 33% number, obviously we are looking at better margins going forward. Again, a few reasons why this is likely to happen. As I've already explained, our phase 3 stations have already broken even. We definitely expect for FY19 to be better in terms of macroeconomic factors. Of course, there will be the seasonality impact where really Q3 and Q4 will be the big quarters of the coming year. Also, we must remember that the next year is the precursor to the election year, so we do expect government spending, etc., to be high. We've seen some very good results come out from certain sectors like FMCGs and auto. And again, in quarter 4, the big categories that spent apart from government were auto and BFSI. So we do expect that that will be a continuing trend in the coming year.
Okay, just taking off from that last point where you said, you know, FMCG, government, autos, etc., those guys have been spending big time. So what has been your advertising volume growth in this quarter, and what's the outlook going forward, especially since it's going to be an election year?
Sure. So the radio industry in FY18 showed a volume increase of around 5%. As we discussed, it's been a tough year. And Radio City grew at 8% in advertising volume. And this has really been a broad trend over the past several years where we grow 2 to 3% higher than the industry. And we expect that this will be a continuing trend in the coming year. As far as the industry is concerned, I think we will be seeing anything between 10 and 12% volume hikes because of the tailwinds that we will get because of the economy.
Okay, you mentioned about the phase 3, radio licenses. So could you just update us on how exactly did that pan out, the e-auction process of the phase 3 FM radio licenses?
So, in phase 3 auctions that happened 2 years ago, we decided that we would always ensure that our footprint would be around 60 to 70% of the larger FM footprint that is available in the country. And through the auctions that we participated in, where we took in 11 more stations, plus our recent acquisition, of course subject to MIB approval, of Calcutta, takes our footprint up to 72%. We believe 72% is a very good footprint for us to be a relevant national player, and therefore we would not be participating in the rest of the auctions.
And what's the kind of growth that you could guide us for FY19, and any plans that are there to enhance shareholder return, since you're not keen on participating in the next phase of radio auctions? Given that sort of a backdrop, what's the growth that lies ahead?
So we don't do a formal guidance, but as I've said, that last year our growth was around 10% on an annualized basis with a 33% margin improvement. Clearly next year is likely to be better, and therefore our growth will be certainly better than 10%, and we hope to go back to margins that we had when we had just the phase 2 markets, and our investments of phase 3 would have played out completely. As far as the dividend policy etc. is concerned, we follow the aggressive dividend policy that Jagran has, and clearly looking at maximizing shareholder returns in whatever way we can.
Okay, on that, we leave it at that. Thanks so much, Ms. Purohit, for joining us and helping us understand what exactly went by in Q4, and of course the outlook for FY19 as well. The street certainly seems to be rewarding the stock, which is higher by more than 3% as we speak. That's music broadcast for you.